And the next segment is before buying a house, get answer to the key question. And again, I want to remind you, a house is an investment property. So what are the key questions that everyone should be asking themselves before buying homes? I basically divided it to a few categories. And the first category is underlying economy, real estate market, neighborhood, and property. So these are the four categories that everyone should be investigating before buying a house. Okay. So in the underlying economy, what do we have there? What do we include? Population and job growth. Okay, population growth, we talked about it. We want to see that there is a gap between demand and supply. We also want to see, obviously, the population growth is a derivative of job growth, of industry that are attracting new employees. Obviously, we have the historical and projected based on the economy and major industry. And we want to look what type of industry. Is it a service industry? Is it a manufacturing industry, financial industry, and so on? Because each one of them has a typical profile of potential buyers, potential renters, and potential demographics which are going to impact our decision. As far as the real estate market goes, a long term, we want to look at the long and the mid-term trends. Okay, real estate is a big mass. Employment is a big mass. It takes a long time to create job opportunities for industries to be established and so on. So we want to look at those long-term economic trends as well as real estate trends. We want to see the ratio between supply and demand. We want to look at the price and affordability. Remember that if the affordability is too high, basically we would not be able to find renters. If the affordability is too low, what kind of exit strategy we're going to have? We might be able to buy a home, but we would not be able to sell it. So you have to find a very fine balance between in the affordability, not too high, not too low, and so on and so forth. A rental market and vacancy. Obviously, we want to make sure that that is as a factor. Location, okay. What are the location? Are we going to go into location where we see population growth? What sort of demographics in school? Is it school? Are the schools good one or not good one? Who is our target market? We want to find the owners renters ratio. Again, a neighborhood with a large percentage of ownership typically will look much better than a neighborhood with a large percentage of renters. So in addition to that, when you have a large percentage of renters, you're basically going to have also a lot of competition. So this kind of ratio is a very important one. Are we interested in property types, single family, condominium, townhome, multifamily? All those kind of factors that are impacting our decision what to buy and where to buy and when to buy, what to buy, how to buy, and so on and so forth. So if we look at one of the most interesting one is the population growth. We see and we look at the United States as it's projected to be in 2030, and that was developed back in 2005. So it was like a 25 years projection. And if you look, they basically divided the United States to roughly 10 what's called megapolitans. These are areas where the population grows and basically put many cities together and made it a one big area. Like we have in the Northwest, Northern California, Southern California, we're looking about Arizona, Las Vegas area. And then in the South, we look at Texas, Gulf Mexico, and Florida. And in the Northeast, we see the Great Lakes, Atlantic, and I-85 corridor, which include Atlanta, Georgia, North Carolina, South Carolina, Tennessee, and Virginia. So the 85% of the population, most of the population in the United States, the overwhelming majority of the population in the United States is focused in this area. And you see this area of the United States population footprint is very minor. Actually, we'll see that this area in a second, which is the intermountain area, which basically has experienced a lot of growth in the last 15 years. And if we look at the map, and this is, as we indicated, from 2015, if we look at an updated from 2018, we see that the area with the very large population growth is more in dark, and we see the south, the west, okay, the west, and we see the east and the south here. So as you see, most of population growth is in this belt of the south and the west, okay? That is the belt, okay? While we see in the north, the population growth is very, very small compared to the south and the west. Okay. So if we look at where the percentage, if we look at this chart of between the south and the west, we have almost 87% of the entire United States population is focused in the south and the west. And if we then ask ourselves the question of how much homes we're going to need, okay, we're going to need basically almost 2 million units per year to accommodate that kind of growth, okay? So we see that the growth is mostly concentrated in the south and the west. We need at least about 2 million units, new units every year to accommodate that growth, okay? Which is basically the demand side of real estate. So but then if we take a look, and we see new housing units started, okay, we see that the blue, okay, what is the second? The blue, which is total units and single family home. So we see that the total units, both multifamily as well as single family, we have about almost 938,000 a year, and we have total, which is 1.6. So we have about 400, roughly about 400 multi-unit. So we clearly see with this number of 2 million that we see here, then it's clearly that we have a shortfall. Basically, as you remember earlier, we talked about the gap between supply and demand, and we clearly see that there is a gap between the 2 million here and actually the supply that comes online. So when we talk about our investing strategies, okay, we'll talk about the investment strategy that we have, okay? So what is our investment strategy? So our investment strategies is literally geared, okay, very focused. It's very focused. It's focused on generate passive income for retirement. Our primary objective is passive income for retirement. We want to establish a portfolio that's going to generate us income for retirement, okay? Obviously, the secondary parameter that we're looking for is build wealth and legacy. Wealth that we can basically benefit from it from our retirement time, and legacy that we can give away, whatever charity or your family members, whoever you feel suitable. And minimum hassle and risk, okay? We are passive investors. We do not want to, during this working period of our life, we do not want to turn this investment strategy into one that consumes a lot of our time and creates a lot of hassle. At the same time, we do not want to have it very risky, because we want to build a steady stream of investing cash flow to our retirement. And as we indicated earlier, I believe that we should reduce our risk as we get older, as our runway is getting shorter. We need to reduce the risk, and making sure that once we hit the retirement age, we have the nest egg that can provide for us that income, so we don't become burdened to our children, okay? And we can live independently with and not be dependent on anyone else, and as well as not on the government, not on our children, but mostly depend on our investment that we have done over the years. So with that, our strategy is basically that we're going to have, I said, kind of two passes. The pass A, which basically A and B, and which is involved in buying properties which are in the what I call growth areas. These are typically areas which are higher appreciation, and V, properties which relatively generate better cash flows for the same price than they would generate in other places. Okay, so if we assume that we are buying homes roughly that generate about roughly about $1,400 gross rental income per month, okay? And we have a home here that we buy in the growth area and a home here that we buy in the value area. So if we look at our return, so if we look at this equation, which is total return equal cumulative cash flow plus appreciation plus strategic improvement, and I will explain that in a few minutes. So cash flow, typically what we have seen from our experience, that areas that have high cash flow, then typically the appreciation there will be below the U.S. median, okay? Places like Tennessee, Oklahoma, Kentucky, and so on. Places like which have high appreciation, like California, some Arizona area, some Atlanta area, will typically have a lower cash flow. And the reason I'm using this image of portfolio is that you have to start looking at your real estate holding then as a portfolio, because you have a collection of properties with different profile, and you have to look at your total return of the entire portfolio versus just only one property by itself. Obviously, each property that you buy, you want to buy it in a relatively good area, and you want to make the due diligence and so on, so you don't buy a lemon, but you have to balance one with the other. For instance, properties that might be in the area of growth are more expensive than and generate maybe the same money, are more expensive that are in the area of more value. So for instance, we can buy a home in Arizona today, typical for a 3-bedroom, 2-bathroom home, maybe about 1,500 square feet, roughly going to cost you about $240,000 to $250,000, $260,000. It's going to generate for us about $1,200 to $1,400. We can buy the same home we can buy a home for about $200,000 in Tennessee, that they're going to generate us an income of about $1,500 to $1,700. So the appreciation there historically is a bit lower, even though that we have seen in recent years a very nice appreciation in those areas as well. And that's part of the reason for that, is that there is a shortage in supply and there is quite a intense demand. So what is strategic improvement? Strategic improvement is typically, or what I refer to, is buying investment properties in area where the cost of the land is very expensive, like California, like Silicon Valley. And if you buy properties where the land component is very high and you have enough land that allows you to improve, to add square footage, to add a second floor, to expand the home, then you already capture 2/3 of the cost, and you are basically can increase the value of the property significantly by investing only in the remodeling, only in the addition of square footage. This is what I refer to as the strategic improvement. Okay? So with that in mind, what we do is over time, you build your net wealth, you build your asset base over time. Whatever time interval between the purchase of one property to the other, you see fit. And then I divide our investment life into 2 phases. Okay, The first phase is the equity focus, where you're really focusing on building basically you're building your asset base during this period, and this is the equity focus period. It's a period where you still maintain a job and you're not necessarily looking for positive cash flow to build your to enhance your lifestyle. You're not looking for $1,000, $2,000, $3,000 additional dollar a month to enhance your lifestyle. You mostly want to focus on building your asset base so you can turn that asset base into your cash flow generator during retirement. The second phase is when you are going into the cash flow focus, where you basically probably somewhere here in the 60 to 70 years old, where you phasing out of work, you want to go into retirement, and now you have built enough asset that they become now your net cash flow positive generator, okay? And you can transition, if you want, from single family home, which basically these are being advocated, to a multifamily or to DST, a Delaware Statutory Trust, which is basically an investment in real estate without all the hassle of maintaining mortgage and finding new tenants and so on and so forth. So this is another strategy of actually DST is a very much passive way of managing your asset to retirement, which allows you to travel and so on and be relief of all the issues associated with being a landlord, as I mentioned, maintenance issue, payment issue, and so on. And this is mostly what's called mailbox checks that we receive on a monthly basis, and so on. Again, if you want more details, we will be able to provide you that. When we are transitioning from a single family home into more multifamily home are typically more geared or more efficient in terms of cash flow. So it depends if you want to do that. It's depending on the circumstances and so on. So we want to share with you a few examples that we basically have gone through with our client and ourselves. So this is a recent example for East Tennessee, which a transaction that basically was almost a year ago. As you can see, this house is still under construction. This house was bought directly from the developer, and what we see here that the total cost was about $235,000, and it's a 2,600 square feet home. So how is it possible to buy something like that in California and Silicon Valley? The answer is obviously no. For $234,000, this is roughly the price that my wife and I are thinking about adding an ADU in our house, which is roughly between 700 to 1,000 square feet. So no way in the world that we would be able to buy something like that in our area. So very, very different what we can expect here. And the monthly rent, the anticipated rate was about $1,500. It actually was a bit higher than that. In addition to that, we are actually also putting a reserve. We put reserve every year on our property to make sure that if the refrigerator will stop working, the air conditioner and so on, we have the reserve that we basically can take care of those maintenance issues. Also, when we look at that cap rate based on total cost, it's about almost 5%, 4.9%. If we're looking at cash on cash return plus equity buildup, which is basically about 15%. So we roughly estimate you're going to make 15% per year on your investment when you're taking the cash flow consideration as well as the equity buildup. So that's one example of that we directly have done last year. In this particular area, we manage roughly about 30 homes in this area. This is another example, and this is in Canton, Georgia. As you can see, this was bought during the previous financial crisis. This is a townhome that we bought from the builder directly. It's a 3-bedroom, 2.5 bath, 1,600 and 1,700 square feet on a relatively small lot. So this particular home, we have a very limited availability of doing what we call the strategic improvement because it's a very small lot. It bought the builder for $117,000. It rents today for about $1,300 a month. Okay, fair market value as of last month, it was 280, between 220 roughly to $240,000 rent fee. So this is an example of one of the examples. Another example we bought also during the financial crisis here in Arizona, basically in 2010, Mesa, Arizona. We bought this. It's a 3-bedroom, 2 baths, 1,500 square feet home on a lot of about 6,000. This home has a better chances of addition, the strategic investment, but the question here is the cost of land is a small one. It's not as critical as we have here in California. We purchased it, REO, which is real estate owned. We purchased it from the bank for $100,000. We're getting about $1,400 on it for a month. And the fair market value of this property, again, as far as last of 516 on Redfin, is about $230,000 to $260,000. So when we bought this house, okay, there is something called intrinsic value. Intrinsic value is when the fair market value is below the replacement cost. This is a house of 1,500 square feet, okay? Remember, they build homes roughly from between 90 to 100. This is the area between 90 to 110. So let's assume $100 per square foot. $100 per square foot, the cost of construction was excluding the cost of land is about $150,000. So this is the greatest purchases you can do, because once the market stabilizes, obviously no new builder are going to build new homes when they're going to lose money. So this is what I refer to as intrinsic value, where the fair market value is below the cost of construction, and these are the best purchases you can find. It's obviously very difficult to find. There's a lot of competition on it, but this is the kind of investment that maybe there is a chance they're going to happen again by the end of the year. This is another example that we personally, the Urban family, actually bought back in 2018. This is in East Menlo Park. This is a house that it was a 1,100 square feet, 3-bedroom, 1 bath, and we have turned it to 3-bedroom, 1,200 square feet, 2.5 baths, and we're renting it right now to students. It has almost a 6,000 square feet lot, and this is an exceptional example of strategic improvement, where we actually already capture the price of the land, and any expansion which we can easily do in this area. Right now it's about 1,200 square feet. We can easily add another 1,000 square feet where we already have paid for the cost of the land. And this is next to Facebook, so we're a big believer in this area, and we are basically looking forward for that. So we bought it for about $1 million, $1,025,000. We put into it around another $250,000 of work into it to make it very modern and compelling to young adults. A square foot is about $1,200. Our current rate is about almost $5,000. We also put some money in reserve. Our cap rate is about 4%, and what we expect to see a return of almost 18% a year because of the appreciation. We already have seen homes which are smaller than that in that neighborhood, which are going for about $1.4 million, 1.3 to 1.4, which are actually smaller than these homes and not as developed. Another property which we actually closed last week. This is in San Jose. One of our clients who actually this is the third property that locally that he buys with us, and his second locally investment property. This is a property here in San Jose where it's a 3-bedroom, 1-bath, 1,260 feet on a 6,700 square feet lot, and that is a prime. This is the lot size is primary for strategic improvement. One of the improvement is number one, turn that into a 3-bedroom, 2-bath, and there is enough place to do it. Another thing that is a major benefit, it has a very big garage, and anyone who is aware of what's happening today with the state law and so on is aware that you are able today to extend ADU and so on, and a 1,600 square feet garage can be easily turned into an ADU and be rented as well. Purchase price of $960, required $70K of improvement, estimated rate on $3,200 plus only on the main units. I do believe that if we convert the garage, we easily can probably get somewhere between $1,100 to $1,300 easy on it. So this is examples of properties that we have purchased recently in this area. And this is, as I mentioned before, is the ADU and the ST, the strategic improvement, add master bathroom, convert garage to an ADU. So that is an example of some of investment that we've done. Just close it, as I mentioned last week. Another thing that I want to show you is what I call how we leverage an exchange. Okay, and this is yes.
We have a couple questions here from Laura about the examples.
Okay.
So the question is,
go ahead.
Do you want? Okay. Does the cost include property management? Is the first question. And the second question is, are these examples of your personal investments or are they investments of your clients?
So the first question was, does it include property management, or if we do property management?
Does the cost include property management?
Okay. When we are doing our analysis, it includes everything. Okay. And we are very conservative in the way we are doing our estimate. We are overestimating our expenses and underestimating our income. So we include everything. We include vacancies, we include maintenance, we include property management, everything. We allocate maintenance every year. Even though you don't typically have maintenance every year, we typically allocate them. So we are very conservative how we're doing our analysis. And we do include everything in our analysis. And the second question was, some of them were our properties. What was it?
Are these examples of your personal investments or are they investments of your clients?
So I have only one example that is mine. That is the property in East Menlo Park. The other are clients' investment. We generally have under 300 properties, over 300 properties under management in 8 different locations in the United States. And we are referring to ourselves like a second-level property management, which basically means we help our client manage their properties, and we are their focal point if that's what they choose to do. And that's what we refer to the second-level property management. We manage, as I said, over 300 properties. Every one of our team members own their own properties. Myself included, my wife and I own about 20 properties locally as well as outside of the area. Locally, we own 2 properties. Outside of the area is the other properties we had. Some of them we have some partners. Every one of our team members, Elan, Nati, myself, and others, own investment properties. We believe in that long-term approach to real estate investing, and we believe in this asset class that has worked for many people and believe will work for us as well. Other questions?
There's a question from Pam. Yes. What do you factor in as the interest rate on debt or investment properties? are you buying in cash?
We have some clients who buy in cash, but I would say the overall majority of our clients do not buy in cash, and we do not advocate actually buying in cash because you use the leverage. As far as the interest rate goes, it varies, depends on how many properties you have, what the price point, what's your FICO score, debt to income. But in general, I would say it varies between 3% to 4.5%. Also, it depends if it's a 30-year loan or it's a 15-year loan or it's an ARM. There's a lot of factors that are impacting that, but we are going to help anyone who will be working with us. We're going to help them do the analysis in a way that is basically reflect all those scenarios in their calculation. Okay? So let's move on with this leverage. And we're going to have, typically we're going to have the break for questions in a few more slides. But we have about 5 more slides before our next break. So, so here is what we talked about, leverage and exchange. So this is, Laura, this is a particular example that we have personally done, my wife and ourselves. So this was a property that we bought in basically in 1987, I think, in 1987, yes, for about $175,000. We sold it in February 2004 for $595. Today's fair market value, you see the last update, I've checked the last price is in March of this year. And the fair market value based on Redfin is about 1.3 million. The rent that such a property can generate today is $3,500. It's currently owned by it's occupied by an owner, so it's not rented. But based on a going rate in the area, we estimate the rent to be about $3,500 a month. When we sold it, and when we did an exchange, we put $25,000 in our pocket, and then we bought basically about 6 properties. 6 properties in Phoenix, and in Phoenix, this is all Phoenix area, and this is one in Las Vegas. So today, fair market value of that is about $1.5 million, okay, which you already see is higher than the property here in Santa Clara. And this is an estimate because what we see next is that we actually sold that back in, when did we sell it? I don't remember. I have to look. Actually, we sold it a few years back, and with a very nice profit. We sold it almost, you see, for on $100,000 profit. We did an exchange, and we bought 3 properties in Tennessee, which for a total of about 716. So we went from 260 to 716, and from a rent of about 1,100 to almost 4,000. So our total portfolio of just of the sale of a single home in Santa Clara went from today's market 1.3 to total asset base of about 1.9, and of a rent, gross rent from almost $10,000 to 3,500, from 35 to almost 10,000. So almost 3 times, 2.5 to 3 times better cash flow, and equity build up faster because we could do a leveraging than actually keeping the property here in Silicon Valley. So building equity, doing an exchange, and that's the example that Laura, as you asked, this is our own personal example, okay? And obviously that's something which we can help you do as well. Matter of fact, we have now a client who also is selling a house in Santa Clara, actually not very far from where we sold our property here. They are going to sell, they're going to bring it to the market. It's a 3-1. Well, it's a very much a similar house to what we sold here. And we're going to bring it to the market roughly between 1.3 to 1.3.5. That's roughly where we can sell it. And we are also considering a similar exchange with that. That's what we have done personally. Our target going to market is probably about 2 weeks to 4 weeks before we're going to post it in the market. So that's actually an example that we are now involved in. So before buying your Silicon Valley house, case for investing in Silicon Valley. So I want to make what are the reasons that anyone should be considering making or purchasing an investment property in Silicon Valley. Okay, so again, I like to categorize it in different groups. There's financial consideration, lifestyle and personal consideration, and family consideration. So in the financial consideration, what do I include there? Too much real estate, positive cash flow without enough depreciation. Basically, it means that you're going to have to pay for every dollar, positive cash flow dollar, you're probably going to have to pay somewhere between 30 and 4% taxes, which is painful when you basically know why would you pay those kind of taxes. And one of the things that we have in real estate, which is very nice, is depreciation. And depreciation basically shelters your income, so you don't have to pay not capital gains, but income taxes on it. Okay? Multiple properties are generating small monthly rent and require too much management. So for instance, if you are getting tired of age of retirement and you have too many properties with too much hassle of management, and there is a kind of small amount, we know that in outside of the area, we're talking about a rent income between $1,400 to maybe $2,000 at most. And here in Silicon Valley, we're talking about at least on a single family home, $3,000 probably to the house that we're getting in East Menlo Park for about $5,000 a month. Okay, you own properties in low appreciating area. So we've seen that California, Silicon Valley has a very high average annual appreciation. We look at areas like Atlanta, Tennessee, Arizona, and so on. They have a lower appreciation compared to Silicon Valley. Want to consider the number of properties under management. Basically, you want to take all those properties and consolidate it into a single property, which typically is also possible. So let's say we have a few homes in Tennessee. I can sell one or three, I can see 3 properties, take that money and buy a more expensive property in Silicon Valley. So I got rid of my hassle of managing multiple properties. I can do management here locally myself more sometimes, and maybe, and we can help also. And one of the consideration, have a large amount of invest and don't want too many properties. It depends on how much money you have to invest. If you want to, let's say you have $500,000 or $1 million that you want to diversify, maybe from the stock market and so on, and you don't want to buy $200 to $250 homes, you want to buy maybe homes, put $500,000 into 2 homes versus buying 5 or 6 homes. No interest in positive cash flow, only high appreciation. So basically, people who are in high tax bracket, any new dollar that they get, they will pay about 30 to 40% plus in taxes. And obviously, you don't want to be in that position. Want to diversify your investment portfolio, stock bonds. You have too much of your money in the stock market. You're looking for diversified to different asset classes. Another thing which is very true in Silicon Valley compared to other places, and that is that the quality of renters in Silicon Valley are much, much higher. They typically take a better care of the house. They typically don't have delinquencies issues. They typically stay in the house for a longer time. You see the turnover in other type of properties is much higher than we are experiencing here locally, typically. Obviously, it's not true in all cases. Adding value and cash flow by adding square footage. We talked about the strategic improvement. When we know 2/3 of the cost of purchase a home is the land, and since you already paid for that, it makes a lot of sense to be able to add square footage, add ADU, convert a garage, which is going to generate your income. A lifestyle and personal consideration. Your current house is not a good fit for your next phase in life. Let's say you have 3 kids today, and you have maybe 5 bedrooms, and obviously children will eventually leave the house. You want to stay in this area, and all you want is maybe 3-bedroom, 2-bath home from 3,000 square feet to 1,500 square feet, and you want to basically capture some of the appreciation of the future. this is a way for you to better get into the market when taxes are less, and you can benefit from the appreciation as well. Believe real estate investing, but will invest only within short derivatives. And there are some clients of mine who do not believe or do not want to be involved in a remote ownership or investing, and they prefer to be within a driving distance, and they want to manage their own property by themselves. If that's the person you are, definitely that's a good place to start. You are renting. For instance, there are some people who have typically children, and they want their children to be in very good school, whether in the Menlo Park, Los Altos schools, but they cannot afford the median price in Palo Alto, which is about $2.5 million. So they can basically rent a house there at a much reduced cost, and so that they are not missing the appreciation train that is keep moving faster and faster. They can buy a house for their next phase of life, retirement phase, when the kids are out of the house and school are not a factor anymore. But that's basically where you should basically, again, benefit from the lower property taxes, benefit from the appreciation, which is going to happen over the years that you will live in a rental property because your kids want to be in a better schools. Family consideration, establish footprint for children. So as I mentioned earlier, I have 2 sons, and one of the consideration, you want the kids to be around you. How can you help them establish their footprint nearby? And that is getting them some sort of whether you buy for them, maybe a condominium, a townhome, or something, but just establishing a footprint for their future life locally. And as well, whether it's children or parents, the same consideration. So in my opinion, there are a lot of very good reason to consider investing in Silicon Valley real estate. I've mentioned a few of those. I'm sure there might be other as well. Anyone who has questions, I'll be happy to discuss. And when we talk about Silicon Valley real estate, then a lot of people probably are thinking about what's the future of Silicon Valley real estate. So as you can see in this slide, it's a slide that goes back to 1985 when my wife and myself arrived to Silicon Valley. And basically what we see here, that the demise of Silicon Valley was predicted many, many times before. And basically, we have some conversation today about the impact of the coronavirus and so on, remote working, is Silicon Valley real estate in a bubble or not, and all those questions. The world is definitely changing. There's no question about it. And there will be some implication, but as long as Silicon Valley can maintain its unique position as a center of the world of innovation and technology, I'm less concerned about the Silicon Valley real estate, which in my mind is a very simple and clear derivative of how well the local high-tech innovation industry is doing. With that, and I would like to get a few questions. If there are any questions, let's make a short break here. I want to keep you on time. So where are we in terms of questions? Do we have any questions on the chat? Anyone wants to jump in with some questions?
We have a follow-up from Laura regarding earlier on. She says, thank you. Could you elaborate what are the
Yes, I have a slide that we will talk in a few minutes about the services management. Sorry, can you repeat the last section?
So, yeah, she has a comment on your personal transaction where you took the proceeds and put it into 3 other properties. She's commenting that it's an amazing transaction management.
Yes, it's not easy. You need to have the expertise and the understanding of all those elements. But this is how you build your net value. This is how you plan for the future. And the good news is that we can help you manage that process. And that is, as I mentioned, we are bringing a house to the market in about 3 to 4 weeks. The owners of that property here locally is considering the benefits and drawbacks, and I'll talk about drawbacks in a minute, of making such an investment. And we are happy to help you if you're interested, and walk you through the process and help you through this. And these are the kind of expertise that we bring to this partnership: knowledge, experience, connection. We've done it before. We're here for help you through the process. Other questions?
The first part of her question was, can you elaborate on the business, on the services you provide? What is your business model? I don't know if you answered that.
What I said that in 2 slides or so, I will talk about it in detail. Okay, so I'm moving forward. So before buying a house, okay, drawbacks of ownership, owning rental properties. So I want to be very transparent that, like everything else in life, there are good things and bad things. And anyone who is considering becoming an owner, I want to make sure that they have a full and clear understanding of what does it mean to be an owner. So these are the drawbacks that we have identified over the course of the last 35 years of being a landlord. So drawbacks, tangible. We obviously have the beginning of the process with the search costs, inspection, appraisal, travel, and so on. Transaction costs, okay? Illiquid asset. It's not like being in a stock market where you can click a mouse and you're getting into a position and you're getting out. It's an illiquid asset. The cost of transaction is high typically. As we say here, it can vary, depends on the asset class, location, and so on. So that's something which we should never forget. Administration overhead. Again, there is some management associated with that, even though that we are what we consider ourselves, we have a property management, and we are also a second level property manager. And there is some quote unquote hustle associated with managing that, unlike, again, a hustle of managing your stock portfolio, bond portfolio, and so on. Expenses, interest, insurance, taxes, maintenance, property management, legal, and so on. So obviously there are expenses there. Vacancy while paying bills, meaning while maybe your property is vacant, you still have to pay a mortgage, interest, taxes, insurance, utilities, and so on. All that things can happen. Eviction, tenant damage. We have a sample of 300 properties, and we know that we have some of those issues are coming out, but relatively still today, it's not bad. I do believe it's going to get a little bit worse as we move to the next part of the year because of all the COVID implication and so on. But nevertheless, though, definitely you see that. Lawsuit. For the first time in 35 years that I'm a landlord, I've been sued in Atlanta, actually a frivolous lawsuit, which probably the tenant, I believe, will lose. But nevertheless, though, even that the tenant will lose, I'm going to have probably $2,000 to $5,000 out-of-pocket expenses. Again, the good news is for 35 years, it's the first time it happens to me. Intangible time, and the time is basically, I say that it doesn't take more than 1 hour per month per house. So typically, you have the property management dealing with this issue, as well as we are actually helping you as well in this process. Frustration of having to deal with tenants, contractors, property management, and so on. And that's something which is happening. You know, anytime when you deal with people, you have issues. And to be honest, the people who are doing the property management are not, are not engineers. So the kind of response time is a little bit different than what we expect. They're also a different part of the country, which they have a different way of doing business. So these are the kind of things that we will have to deal with. Side of ownership and obligation drop value and liability, which is true with any asset. And from that reason, we basically say that being a landlord is not for everyone. And we want to make sure that everyone, before they make that kind of decision to get into that, is basically aware of those downsides. So as for this is the question that Laura asked us, okay, TAG, the urban group house buying services. So we look at our services in two ways. The outside of Silicon Valley, and we do divide them also into phases. Before you buy, okay, and all the services that we provide. Remember, you can get a copy of that presentation. All you have to do is to send us your name and email address, and we'll send you a copy. So all those services that we provide before you buy, the services we provide after you buy the property, okay? And Laura asked us about the business model, and I'll answer that in a second. And also when you basically, while you own it, and when you want to list it. So basically, the way we work basically on a very much on exclusive base. And our agreement with our clients, after they fill a questionnaire, our agreement basically states that we are working on an exclusive basis only with you and in the area that we are working. So the exclusivity doesn't apply for the entire United States. It's just in the particular area that we decide to, where you decide to work with us. And our services include basically the 1, 2, and basically once we have a signed lease, with the contract, with the tenant, then we are basically getting our consultation fees. Our consultation fees is typically between 2 to 3%. It depends on the value of the property and so on, but in general, it's about 2 to 3%. And as I said here, it's only payable. It's payable only when you have a signed lease with the tenant after we finish the entire process. In addition, it comes with an automatic 2-year property management support. And I'm talking about here the second level property management support. You still will be responsible for paying property management fees to the local company, but our services that will be for free for 2 years. Typically, if you are like most of our clients who don't stop with buying their first one property, they typically buy multiple properties. We waive that 3rd year and 4th year, 2nd tier property management support for the sake of continuous business, referrals, and so on. And the other part, while you own the property, we basically can help you, depends on the individual himself. There are some individuals who prefer to do all of that by themselves, some others who don't have the time, and we help them with that. And obviously, when you're ready to list the property or sell the property, we basically are there to help you. So that is the Silicon Valley, the outside of Silicon Valley. For Silicon Valley, it's a little bit different, but basically, obviously, the first part is similar, okay? Before you buy, all the consideration, education, and all that kind of will take place. It's very similar, but not exactly. And obviously, once you buy it, you also this particular case, okay, we do not charge. We do not charge typically services, okay? But it also depends on the work. If the house is a moving-ready house and you don't have to deal with anything, then it's free. We're going to help you with no cost, find tenants, screen tenants, and all that stuff. If it does involve with management, contractor, and time-consuming for our perspective, we do charge, and it's a per need basis. So we don't have the typical property management of 5 to 10%. We basically have an arrangement which is based on what activities do you need us to do. So that's approach. And obviously, we are always there for you as advisor And if you, as I mentioned, if you want to do property management, we can help you. So in this particular model, you don't pay us anything except obviously when the transaction closes, we do get paid from the seller of the property. And we're going to provide you assistance for free as long as it's not an incredible time sinks like managing contractor and so on. All the sign of lease and screening of lease, this is actually on the house. We do not charge you anything for that.